Okay, so in this video we're going to have a look at some of the ways and the reasons why we do see fluctuations in the values of currencies, why they do appreciate, why they do depreciate in their value. And in particular, we're going to focus on three key influential factors, and they are, as you can see, interest rates, inflation rates, and also market expectations. Let's go through each of these in turn. And we'll start with interest rates. All around the world, we see governments using interest rates as part of their broader monetary policies to either increase or reduce the supply of money in that particular country. And it works like this. So basically, when, for example, in Australia, we have the Reserve Bank of Australia setting a relatively or comparatively high interest rate, certainly on a global scale, that means that there is greater demand for the currency because, of course, if you have Australian dollars and there's a high interest rate, that means when you have those that particular currency, you're earning more interest on that. So people want to get Australian dollars, which means that more people are seeking to purchase Australian dollars, which of course means that there's greater demand. And as we know, when there is demand exceeding supply for anything, in this case Australian dollars, the value of that, the price of that, in this case the Australian dollar, increases. So what we generally see, the higher the interest rate, the stronger the value of the particular currency. Of course, the inverse applies as well. When we have a lower interest rate, there is less demand for that particular currency, because if you have holdings in, for example, Australian dollars and there's a low interest rate, you're earning less for your Australian dollars as they sit in a bank, for example. So people are more likely to sell their Australian dollars, and again, as we know, when supply exceeds demand in this time, you generally see a reduction in the price and accordingly the value of the Australian dollar. So they do play a key role in the fluctuations that we do see in the values of currencies across the globe. And as a consequence, the interest rate differential between at least two, if not more, countries actually influences things like the flow of capital between countries as people sell certain currencies and seek to purchase other, depending on the level of interest rates. The demand, of course, for each country's currency, given that we've explained that the level of interest rates makes it more attractive to investors, and also as a flow-on effect, the appreciation and depreciation of the value of each of these currencies against one another. So we can clearly see from an exchange rate perspective that interest rates are a vital contributing factor here. Inflation rates are related to interest rates and also have a large influence on currency fluctuations. As we've spoken about previously in the semester, inflation refers effectively to a consistent increase in the pricing of goods and services within a particular economy. So effectively what we're talking about here is when you see accelerating inflation, that means that each unit of currency, whether it's Australian dollar or Japanese yen, whatever we're talking about, is actually worth less because, of course, as prices continue to go up, each Australian dollar or whatever currency you're looking at actually is buying you less and less. So it diminishes rather the value of the funds, and as a consequence generally increases the incentive of businesses in particular to withdraw their capital from that currency. So because of course as the value of the funds in that particular currency become worth less, the firms are much less likely to want to continue to have that currency and more likely to want to take their money and funds out of that and put it into another currency which is worth more. So as a consequence of this, we often see what is known as capital flight, where significant amounts of capital or funds are taken out of one particular currency and put into another. So it reduces the real value of money as the general level of prices increases, as we've discussed, and in extreme cases can also lead to hyperinflation, which effectively renders a currency worthless. And we've seen a few key examples of this, even stretching back now over, say, the last 100 or so years. A prominent example that's regularly cited is the German mark, the German currency after World War I. And there was a whole series of events which led to that particular currency being devalued, but there was extreme levels of inflation after World War One as the German government printed more and more money to try and stimulate the economy after the First World War, and it got to such an extreme state, there was so much money being printed, which of course means that each mark that was in the economy was worth less and less as that supply of money increased, that you got to a point where people were literally using the notes, the currency, to as stovetops and to cook things because it was cheaper than the price of gas. Such was the low value of each individual unit of currency. Things got even so crazy, kids started making kites out of their currency, out of the notes, the German mark. So clearly things getting a little bit out of hand here. More recently, if we look to Zimbabwe, in the 21st century, we've had significant problems there in terms of the almost worthlessness of the Zimbabwean dollar at the time. And it got to the point, and we'll talk about it in more detail on the following slide, but it did actually get to the point where you could have a note for 100 trillion Zimbabwean dollars. Just imagine having that number in your hand. But while, as we'll show in the following slide, while that sounded fantastic and you'd feel pretty rich holding that, it actually was worth almost nothing. So the key overall takeaway here then, of course, is that when we see high levels of inflation, even if it's not to the extent of hyperinflation, you generally see a reduction in the value of that currency, which of course means it is devaluating or depreciating on the foreign exchange market. Market expectations also play a significant role in the value or increase or decrease in the value of a particular currency. So it's not necessarily something that's actually happening, like an increase in interest rates or increasing inflation. Sometimes it's what people might expect that will happen, which causes the value of a currency to fluctuate. So we can see expected appreciations in currencies. For whatever reason, people may anticipate and businesses may anticipate that there will be an increase in the value of a certain currency. We spoke about that previously in the last video. Or there might be, for an example, an expectation that a government will raise interest rates, which, as we spoke about on the last couple of slides, leads to an increase in the value of that particular currency. When that does happen, we usually see a consequential inflow of capital into that particular economy. As people expect it to increase in value, they want to buy that currency so that they can see their funds increase in value. So that, of course, increases the demand for the currency, which in turn it becomes sort of a self-reinforcing effect where it does actually lead to an expected increase in the value of that currency. The inverse can occur as well. If people expect that a currency is going to depreciate in value, then that generally results in capital outflows or conversion of that currency into another safer currency. And that's certainly what happened with the Zimbabwean dollar in a few years ago, as we spoke about previously. And in fact, by 2009 or so, it had got so worthless that the government literally cancelled its own currency. They have changed it. Now people, if you go to Zimbabwe, it's common to use other currencies, especially the US dollar, given it is seen as a safer, more stable and constant currency, certainly than the extreme hyperinflation we saw with the Zimbabwean dollar. Unfortunately, when you did go to convert your Zimbabwean dollars into US dollars, you didn't get much. And we can see here, if you, for example, had 175 quadrillion Zimbabwean dollars, which was literally an actual amount that you could carry around in Zimbabwe in the late 2000s, and you can see Mugabe was very happy about that at the time. When you went to exchange that for your US dollars, how much do you reckon you were going to get back? You got $5 US. Mugabe was not so happy now, was he? He's certainly less happy in the developments in the last few months, that's for sure. But the key point here is that you can see how worthless each of those Zimbabwean dollars were when you've got 175 quadrillion of them only getting you $5 US, and such was the extent of the hyperinflation there. So it got to such a point where people were just like, we're not going to continue using this, we're just putting it into other safer currencies. And as I said, by 2009 they'd effectively cancelled their own currency. So to try and prevent this, governments do sometimes impose capital control to reduce that outflow of capital, that capital fight that we spoke about previously, but it is sometimes difficult to do. The key lesson, of course, is to act swiftly and to avoid expectation. Sometimes people can get a little bit carried away and it becomes a bit of a frenzy and becomes, as I said, that self-fulfilling prophecy where the expectations actually become reality just because people worry what might happen rather than what actually is happening here. Now, to sort of summarize the key points here, we're going to look at this final slide in this video, which says, as you can see, who is it overall and who actually manages the exchange rate, given all these different fluctuations that we've spoken about as being possible. The governments clearly have a key role to play here. The Reserve Bank in Australia is one of the main central banks, or is the central bank in Australia that we rely on to set interest rates, and as we've spoken about, that has a key influence on the level of the value of the Australian dollar here. The general fiscal and monetary policies employed by governments have key roles to play in determining the value of the national currency. Why then do governments bother to do that? Well, firstly, they'll do it to protect local assets and attract foreign direct investment. Their ability to control and devalue or appreciate or increase the value of their respective currency has a big say in protecting local assets and attracting foreign direct investment, but especially managing inflation. We see it all the time where governments increase interest rates, for example, to try and reduce inflation, to curb spending and reduce the amount of borrowing by the public, which of course contributes towards that inflation. We've also, as we've spoken about, the governments getting involved here to avoid that capital fight. They want to avoid a situation where money is constantly being taken out of the Australian economy and moved into foreign currencies. So there are a number of reasons why governments do this. Does it actually work? The reality is not always, but there are going to, most of the time, there will be some situations where it's as much as anything actually necessary for the government to step in. This might be, for example, if a currency market actually overshoots, like our friends here, oh, nope, just a little bit too far, and actually push the currency values either too high or too low. And this is especially relevant if you as a government are trying to manage something like a dirty float or a fixed exchange rate, a pegged exchange rate, something along those lines where you are seeking to control the relative value of a currency, and those supply and demand forces are actually pushing and overshooting the perceived and desired value of that currency. There may also be instances which require drastic readjustment, or especially from a devaluation perspective. If we've got a situation like hyperinflation, then there might actually be justification for drastic intervention on the part of the government. So there are a number of reasons why governments do get involved here, and also a number of different outcomes in terms of these currency fluctuations that we see. In the following video for this week, we're going to actually have a look at the system by which governments do seek to control this, which is known as the international monetary system.